What's up everyone and welcome back to the channel. Have you ever stopped to think about that handful of coins in your pocket, or that crumpled bill in your wallet? It feels like it's been around forever, right? But what if I told you that its days might be numbered? We're constantly hearing that we're on the verge of a cashless society. From your morning coffee to your monthly rent happens with a tap, a swipe, or a click. The big question we're tackling today is a huge one. Will physical cash actually disappear within the next 20 years? It's a debate filled with strong opinions, a lot of hype, and some surprising truths you might not expect. Today, we're going to cut through all that noise. We're not just going to give you one side of the story, we're going on a myth-busting journey to separate the facts from the fiction. To understand where cash is going, we first have to understand where it came from. Long before we had crisp banknotes or shiny coins, humanity relied on barter. This system worked, but it was incredibly inefficient. It required what economists call a double coincidence of wants. The first major breakthrough came in the form of commodity money. Things like salt, tea leaves, seashells, and cattle became early forms of money. The real game changer was the invention of coinage. Around 600 BC, the Kingdom of Lydia, in modern-day Turkey, created the first standardized coins. These were small, durable lumps of a gold and silver alloy called electrum, stamped with an official seal to certify their weight and purity. This was a revolutionary concept. For the first time, money's value was not based on its use as a commodity, but on the guarantee of a ruling authority. The next big leap in the history of money didn't happen in Europe, but in China. During the Tang dynasty, merchants began to find that carrying huge strings of heavy copper coins was incredibly cumbersome. As a solution, they started leaving their coins with a trusted agent who would issue them a paper receipt. These receipts could then be traded as if they were the actual coins. By the 11th century, during the Song dynasty, the Chinese government took control, issuing the world's first official, government-produced paper currency, known as jiaozi. The 20th century can truly be called the golden age of cash. Following two world wars, economies around the globe entered a period of unprecedented growth, and cash was the engine that powered it all. It was the era of the weekly paycheck, delivered in a small paper envelope filled with bills and coins. People used this cash for everything: groceries, gasoline, movie tickets, saving for a new home. The first serious challenge to the dominance of cash didn't come from the internet, but from a piece of plastic. Credit cards introduced in the 1950s represented a fundamental shift in payments. Real acceleration came with computerization of banking. Magnetic stripes developed in the 1960s, and electronic payment networks emerged. Visa, MasterCard. The rise of the internet in the 1990s opened e-commerce. Amazon, eBay, entering card details on a secure web page to buy from home. The introduction of the smartphone in the late 2000s was the catalyst that ignited the digital payments explosion. It wasn't just a phone, it was a powerful, internet-connected computer people carried everywhere. This device combined a camera, a GPS, and a persistent online connection. That combination created the perfect platform for a new generation of payment solutions leveraging near-field communication, NFC. Fintech startups began attacking payments from a different angle. Square empowered small merchants, while Venmo and Cash App revolutionized peer-to-peer payments among younger users. The transition to digital payments is not happening uniformly across the globe. Sweden is the poster child for this movement. There, cash is used in less than 10% of all transactions. China offers another dramatic example, but with a different driver. The revolution there wasn't led by banks or cards. It was led by Alibaba and Tencent with their QR code-based payment platforms. By contrast, other major economies like Germany and Japan are moving much slower. In those societies, cash is tied to privacy, security, and a tangible sense of control. This brings us to our first major myth-busting moment. The myth: cash is an ancient, unchanging technology fading into obsolescence. The fact: cash has always been an adaptive technology. Modern banknotes are technological marvels: holograms, microprinting, special security threads. Historical data tells a complex story. Cash transaction percentages are falling, yet total physical currency in circulation is increasing. This is known as the paradox of cash. Our next big myth is the idea that digital payments are always better, faster, and cheaper than cash. The narrative promoted by fintech companies paints a flawless, utopian system. The fact is that digital payment systems come with significant costs. While they may seem free to consumers, merchants are charged processing fees for every transaction, typically ranging from 1 to 3%. Furthermore, these systems are entirely dependent on complex and fragile technological infrastructure. A power outage, network failure, or software bug can bring the entire system to a grinding halt. In a world that is becoming more connected and monitored every day, cash offers a feature that is increasingly rare and valuable: genuine privacy. Every time you use a credit card, debit card, or mobile payment app, you create a digital footprint. That transaction is recorded, time-stamped, and stored in a database, detailing what you bought, where you bought it, and when. Cash, on the other hand, leaves no trace. Offline, peer-to-peer, truly anonymous. Financial privacy. Digital alternatives can't match. Beyond privacy, cash provides a powerful psychological tool for financial control and budgeting. When you pay with physical money, you can feel its tangible value leaving your hand. While many people choose to use cash for privacy or budgeting, for a significant portion of the global population, it is not a choice but a necessity. Billions of people around the world are unbanked or underbanked. Cash is also the lifeblood of the informal economy. Babysitters, street performers, farm stands, flea market vendors. In many developing countries, the informal sector makes up a huge share of jobs and output. A rapid shift to cashless would risk leaving them behind. Without a bank account, you can't get a debit card. Without good credit, you can't get a credit card. A digital-only system creates barriers that exclude the poorest. One of the most immediate and profound risks of removing cash entirely is the creation of a permanent financial underclass. Billions lack stable identity, bank accounts, smartphones, or reliable internet access. Furthermore, a cashless society makes every citizen dependent on a handful of private financial institutions. Your access to money would become a service granted by banks or fintech companies. This unprecedented level of surveillance transforms your financial life into a digital panopticon, a prison in which you are always being watched. Our first potential future is one that might surprise the tech evangelists, a world where cash stubbornly refuses to die. Despite continued growth of digital payments, physical currency remains a significant and protected part of the financial ecosystem 20 years from now. The survival of cash in this future would be driven by public demand and deliberate policy choices. A growing public awareness of the risks associated with a fully digital world would lead to a social pushback. This grassroots movement would prompt governments to enact laws that protect the right to use physical money, ensuring it remains a viable payment option for everyone. A second, and perhaps more likely scenario for the next 20 years, is the emergence of a deeply integrated hybrid system. Physical cash doesn't disappear. It becomes specialized and niche. The vast majority of day-to-day transactions become digital by default, but cash still exists for specific purposes. Like sending a physical letter, it becomes a tool for the unbanked, those seeking privacy, and as an emergency store of value. Central bank digital currencies might run alongside cash, offering a public government-backed digital alternative to private fintech apps while highlighting cash's unique anonymity value. This brings us to our final myth, the idea that central bank digital currencies will be the final nail in the coffin for cash. The myth suggests governments will immediately withdraw all physical money, forcing everyone onto new digital platforms. The fact is, most central banks have explicitly stated that if they issue a CBDC, it would be designed to coexist with physical cash, not replace it. Their goal is to provide a safe, public option in the digital payment space. A CBDC is intended to be a new lane on the financial highway, not a roadblock that closes all the old ones. Rather than killing cash, a CBDC might actually highlight its unique value. So, after this journey through the past, present, and possible futures of money, we come back to our big question: will cash really disappear in the next 20 years? As we've seen, the answer isn't a simple yes or no. The most probable future is not a world without cash but a world of complex hybrid systems. Digital payments will continue their march, becoming the default for most transactions, but physical cash is poised to survive. The choice between digital and physical will become more intentional, a conscious decision we make about convenience, security, and freedom. The future of your wallet is still being written, and you have a say in the final draft, and that's a wrap on our deep dive into the future of cash. Thank you so much for joining us on this myth-busting journey. If you found this video informative, please hit that like button, and most importantly, subscribe to the channel and turn on notifications so you don't miss our next exploration. We'd love to hear your thoughts in the comments below. What do you think the future holds for cash? Until next time, stay curious.